Hi everyone, it's Ava and welcome back to your financial journey, and specifically to our credit card and loan series. In today's video, we're going to be talking about secured debt versus unsecured debt. What's the difference and why does it matter? Secured debt is any debt in which you offer some form of collateral to your lender, like your car or your home, for example. If you don't pay your debt back on time to your lender can take that collateral, that car or home, away from you and sell it to get their money back. Secured debt is often cheaper than unsecured debt because the risk that you won't repay the loan is lower for two reasons. First, because you agreed to put up your house or car as collateral for the loan, or as the technical term goes, because you granted the bank that gave you the secured loan a lien. The bank can take that car or home back from you relatively quickly if you stop paying your installments. This is called repossession and does not require a lengthy court process. Second, if the bank has the first lien on your car or home, they have first dibs, so to speak, on the value of that asset if you default. This means that they get the money they're owed first, and even if there are other banks out there who want their money back, they'll need to wait and see if something's actually left over. Examples of secured debt are car loans, mortgages, and home equity lines of credit. For those of you new to home equity lines of credit, HELOCs, think of a HELOC like a loan that you borrow from the bank, but with a credit limit like your credit card. If you don't need the HELOC, your HELOC balance can simply sit at zero. But if you do need the money, you can borrow as little or as much as you need up to the specified limit for a specific period of time, say 5 to 10 years. This 5 to 10 year period is often referred to as the draw period. At the end of the draw period, the repayment period begins. The repayment period varies, but it can run between 10 and 20 years. With a HELOC, your house is the collateral, which is why a HELOC is often also called a second mortgage. If you don't pay your HELOC back on time, your lender can take your home away. So that's secured debt. Unsecured debt, on the other hand, refers to something like credit card debt, where there is no collateral offered to the lender. An unsecured loan can be granted more quickly and informally because there's no need to formalize a lien on any collateral, as for a secured loan. However, an unsecured loan is usually more expensive than a secured loan for two reasons. First, if you default, there can be a lengthy process with collections agencies and in the courts before the bank can get to any assets you may have. And second, in case someone else already has a first lien on an asset. For example, the bank that granted you the mortgage on your house. The holder of the lien has first dibs, and all other unsecured creditors need to get in line and hope that some value remains for them, as we just discussed before. Make no mistake though, even if it's an unsecured loan, like when you don't make your credit card payments on time, your lender may in the end still come and take away your car, your home, or even the piece of furniture or computer you bought with that credit card. But it may take longer, and there's always the risk for the bank that someone else has first dibs from an earlier lien, in which case there would be nothing left for the unsecured lender. And that's why unsecured debt, like credit card debt, often carries higher interest rates to you, the borrower, to compensate the bank for the higher risk they're taking. Whether secured or unsecured debt is better for you will depend on your financial situation. As we discussed earlier, with secured debt, you typically get lower interest rates. But if you can't pay off that debt, you risk losing your house, car, or whatever collateral you put up for that loan very quickly. With unsecured debt, you usually have to pay higher interest rates, but it's often faster to get because you don't have to formalize any liens. Plus, if you default on your payments, it may take a bit longer before the bank can take your assets away. Borrowing limits and application times may also differ for unsecured debt versus secured debt. Sometimes you'll see advertisements like this one, paying off credit cards with a home equity loan or HELOC. Or this one, plan your spring break, using home equity to go on vacation. And it sure does sound tempting to borrow some money for cheaper, but as we explained in our good debt versus bad debt video, linked below in the first pinned comment, It all depends on what you want to do with the borrowed money. So, our first example, taking out secured debt with a HELOC, which usually has a single-digit interest rate, for example in the 6 to 7% range, to pay off unsecured credit card debt that carries an interest rate of 20% or more, may make sense in many cases. That said, financial advisors usually do not recommend taking out new money on a HELOC to pay for the next fancy vacation for spring break, as in our second example. That's a bit like selling the family silver for a short-term pleasure that doesn't generate wealth. And always remember, for any loan you take out, what would happen if you lost your job and couldn't afford your payments? In this worst-case scenario, the bank could come and take your home away, so you'd have no job and no place to live. So always be careful and mindful with the amount of money you borrow, be it secured or unsecured. Okay, my financial friend, I hope you found this video helpful. And if you need a refresher on good debt versus bad debt, then check out this video here from my sister Caitlin. Thanks for watching, and we'll see you again next time.